Hi, in this video we are going to understand what are derivatives and how they trade on the exchange. In order to understand derivatives, let's quickly review what are stocks. So stocks are simply fractions of ownership in a company which has been issued by the company to someone who is willing to provide it with cash, right? So if you are an investor, you can be holding a stock in say any company, in say Apple, right? And you make money when that stock goes up and you lose money when that stock goes down. It was as simple as that. Where did this stock trade? What is the place where you can go and buy and sell stocks? You go to stock exchanges to buy and sell stocks. Now sometime like 20-30 years ago, what stock exchanges started to figure out was that not everyone was buying stocks to actually be an investor in the company. See, if you are actual investor, you think of it yourself as an owner of the business, you would likely hold that stock for at least months if not years, right? But then there were people who were buying the stock the same day and selling the next day. So these people were trying to make quick money to benefit and profit from stock price fluctuations. They didn't have any interest in owning any equity stake in the underlying business. So what exchange did was, it figured out that it can create a product which we'll call derivatives, and derivatives can be of different kinds. We'll go into them in detail later. But effectively what a derivative does is, if you want to bet on the outcome of an asset, it could be stock, it could be a currency like a US dollar INR pair, or it could be a cryptocurrency, it could be a commodity like oil. A lot of people just want to bet on the price movement of these assets. They have no intention of ever buying or selling this asset in actual life. I may want to bet on the price of the oil going up to make money, but I may not really want to buy a barrel of oil to do that. So that is why derivatives were created. Derivative is a simple contract between two parties which agree to exchange a payoff of profit or loss given the conditions on the contract. Now what could be typical conditions? They define the types of derivatives. First are futures. Futures are simple contracts that bet on the price of a security at some point in future. So if oil is trading at $30 today, and we can have a future contract for say December 2020, December 31st 2020. What that means is, if I am today standing in say June 2020, what it means is, I can go and bet with someone what the price of oil will be at the end of the year, and see if we both decide, let's say $32 is the fair price on which we are going to bet. If the price of the oil turns out to be higher than 32, I'm going to make money. So if it is 35 and I was long oil, or I bought this contract, I'm going to make $3 and I'm going to pay the other party. And if the price goes to say $20, I'm going to lose $12 and I'm going to pay the other party. In this contract, neither of us needs to hold oil. We just need to enter into a contract which bets on the outcome of the oil price, and we will exchange the cash flows. So this is what futures is: betting on the price of an underlying asset without owning it. A more complicated contract can be an option. Option is something like saying, if the oil price is 30 today, I want to make money if the oil price goes up and lose nothing if the oil price goes down. So this is a privilege. Like, why will someone take the other side of the contract in which you can only make money? So you are supposed to make a fixed payment, which is called the premium, to enter into this contract, which will be like, if you say I'm willing to pay $3 to someone who says if the price goes up, he'll give me all the profit, and if the price goes down, he will bear all the losses. So if the price goes to 40, you make $10. If the price goes to 20, you don't lose anything, you only lose the premium that you paid. This is called an option, a call option specifically. Similarly, you can have a put option. Put option is something which is just the opposite side of it. You make money if the price falls. If the price rises, you don't make any money or lose any money, and you obviously pay a fixed dollar amount to get this privilege. So these are options. Similarly, you have swaps. Swaps are very simple. This is like exchanging cash flows. Someone may be holding oil and you may be holding gold. The two of you can enter into a swap contract to say that hey, you have oil and I have gold, but I want to hold gold and you want to hold oil. So one way is you physically transfer the assets if you have them, or other way is you simply enter into a swap contract and the P&Ls can be exchanged. So, and there are swaps are of different types. I'll not get into this explanations. Important point here is not understanding what these three things are, but more like derivatives are customized contracts to bet on the price of a security or an asset without owning it. These are used for speculative purposes, or at times if someone does hold a stock or an underlying asset, they can use derivatives to reduce risk or enhance risk in that asset. So this is what derivative means. And now similarly, a stock exchange has segments. It has a cash or a spot segment, and other is a derivative segment. What a segment does is, so in cash or spot segment, you if you want to buy an actual stock or a currency, actually currencies are not really available on stock exchange in physical amounts usually, but some places, some brokers can give you. So if you want to buy an actual stock, you go to the cash segment. If you want to buy a derivative, you go to the derivative segment. Why are these two segments differentiated? Because they require certain regulatory registrations and paperwork to get access to them. But this is what a stock exchange cash and spot segment means. I'll take a pause here. See you in the next video.